All right, Andrew John here, and I need you to lock in for the next few minutes. What I'm about to share with you is not speculation, it's not theory, and it's not another financial news cycle that will be forgotten by next week. This is about a specific rule change that happened inside the Federal Deposit Insurance Corporation, the FDIC, that fundamentally alters who gets paid first when a bank fails. And here's what most people don't understand. You are no longer at the front of the line. You're not even in the middle. You are dead last. Behind the derivatives traders, behind the bondholders, behind the secured creditors, and in some cases, behind the bank's own executives. This isn't coming. This already happened. The framework was finalized in 2011 under the Dodd-Frank Act, refined through multiple FDIC policy statements, and tested in real-world bank failures between 2023 and 2025. And the mechanism is so quietly embedded in the legal architecture of modern banking that unless you read the regulatory filings yourself, you would have no idea your status as a depositor has been fundamentally downgraded. In this video, I'm going to walk you through exactly what changed, why it matters more than almost anything else happening in financial markets right now, and most importantly, what you need to do immediately to protect yourself. Because the next wave of regional bank stress is not a hypothetical. It's a mathematical certainty given the commercial real estate exposure, the interest rate environment, and the maturity walls we're staring at in 2026 and 2027. By the end of this breakdown, you will understand the hierarchy of claims in a bank failure, why your deposits above the FDIC limit are now legally classified as part of the bank's loss-absorbing capital, and the 3 moves you need to make this week to ensure you're not the one funding the bailout. So stay locked in because this is not a drill. This is the quiet mechanism that will determine who preserves wealth and who watches it evaporate when the stress breaks into the open. Before we get into the specifics of the rule change, you need to understand the foundational concept that governs everything we're going to discuss. It's called the creditor hierarchy, and it's the legal framework that determines who gets paid first, second, third, and last when a financial institution fails. Think of it like a waterfall. When a bank collapses, whatever assets are left get distributed in a specific order. At the top of the waterfall, you have secured creditors. These are entities that lent money to the bank with specific collateral backing the loan. If the bank defaults, they seize the collateral and get made whole. Below them, you have senior unsecured creditors. These are bondholders who lent money to the bank without collateral, but they have a senior legal claim that ranks above almost everyone else. Then you have subordinated debt holders, which is another class of bonds that agreed to take on more risk in exchange for higher interest rates. After that, you have shareholders. Equity holders are always last in a traditional bankruptcy because they own the residual value of the company after everyone else is paid. But here's the critical change that almost no one is talking about. Under the new FDIC resolution framework, uninsured depositors, that's anyone with more than $250,000 in a single institution, are now classified as unsecured creditors. You are not a customer anymore in the legal sense. You are a creditor. And in a failure, you rank below derivatives counterparties, below the Federal Reserve's discount window loans, and in many cases, below the administrative costs of the resolution process itself. Let me say that again because this is the most important sentence in this entire video. If you have $500,000 in a bank and that bank fails, $250,000 is protected by FDIC insurance. The other $250,000 is not guaranteed. It becomes part of the unsecured creditor pool and you will only get paid after everyone above you in the hierarchy has been made whole. If there's nothing left, you get nothing. And the mechanism that makes this even worse is called the depositor preference rule, which the FDIC updated in 2011. Under this rule, domestic deposits are given preference over foreign deposits and general unsecured claims, but they still rank below secured claims and derivative obligations. And here's the kicker. The derivatives book at most major banks is multiples larger than their deposit base. JP Morgan alone has over $50 trillion in notional derivatives exposure. Bank of America, Citigroup, Wells Fargo, all of them have derivatives portfolios that dwarf their deposit liabilities. In a systemic failure, those derivatives get unwound first and the counterparties get paid first, and only after that does the FDIC start looking at depositors. Now, the reason this matters more right now than at any point since 2008 is because we are entering a period of acute stress in the regional banking system. Let me walk you through the numbers because this is not theoretical, this is math. According to the FDIC's own quarterly banking profile, unrealized losses on securities held by U.S. banks totaled over $500 billion as of the fourth quarter of 2025. These are losses that haven't been recognized yet because the banks are holding the securities in their held-to-maturity portfolios, which means they don't have to mark them to market. But if depositors start pulling money and the banks are forced to sell those securities to raise cash, those unrealized losses become realized, and the capital base of the bank evaporates. This is exactly what happened to Silicon Valley Bank in March 2023. They had $120 billion in deposits, but a significant portion of their assets were in long-duration treasury bonds and mortgage-backed securities that had lost value as interest rates rose. When depositors started withdrawing, SVB had to sell those bonds at a loss, which destroyed their capital, which triggered a bank run, which led to failure. And here's what most people forget. The FDIC didn't bail out Silicon Valley Bank in the traditional sense. They invoked the systemic risk exception, which allowed them to protect all depositors, including those above the $250,000 limit. But that decision was not automatic. It required approval from the Treasury Secretary, the Federal Reserve, and the President. It was a discretionary political decision, not a legal obligation, and the framework under Dodd-Frank makes it very clear that the default resolution method is not bailout, it's bail-in. Let me explain what that means in plain language. A bailout is when the government steps in with taxpayer money to rescue a failing institution. That's what happened in 2008 with AIG, with Citigroup, with Bank of America. The government injected capital, guaranteed liabilities, and kept the institutions afloat. But after 2008, there was massive political backlash against bailouts. The public was furious that taxpayers were funding the rescue of banks that caused the crisis through reckless lending and excessive leverage. So the policy response was Dodd-Frank, which created a new resolution framework called Orderly Liquidation Authority. Under OLA, the FDIC has the power to seize a failing bank, wipe out shareholders, impose losses on creditors, and convert unsecured liabilities, including your deposits, into equity in a bridge bank or a restructured entity. This is a bail-in. The bank is recapitalized not with taxpayer money, but with the money of its creditors and depositors. You go from being a depositor with a claim on cash to being a shareholder in a failed or failing institution, and the equity you receive may be worth 50 cents on the dollar, 10 cents, or zero. The precedent for this was set in Cyprus in 2013, and I need you to understand this case because it is the blueprint for what can and will happen in future banking crises. In March 2013, the Cypriot banking system collapsed under the weight of bad loans and exposure to Greek sovereign debt. The two largest banks, Bank of Cyprus and Laiki Bank, were insolvent. The Cypriot government went to the European Union and the International Monetary Fund for a bailout, but the terms were brutal. Before any external funds would be provided, Cyprus had to raise capital internally by imposing losses on depositors. Here's what happened. All deposits above $100,000 in Bank of Cyprus were subject to a 47.5% haircut. If you had $200,000 in the bank, you kept $100,000 fully insured, and you lost $47,500 of the remaining $100,000. That money was converted into equity in the bank, which was essentially worthless. Depositors became shareholders in a failed institution. This was not a rogue action by a desperate government. This was a coordinated policy decision endorsed by the European Central Bank, the IMF, and the European Commission. And after Cyprus, the EU formalized this framework across the entire Union through the Bank Recovery and Resolution Directive, which gives regulators the explicit authority to bail in depositors in any future banking crisis. The United States has the same framework. It's embedded in Title II of Dodd-Frank. The FDIC has the authority to convert uninsured deposits into equity during a resolution process. They have the authority to impose haircuts, and they have the authority to do this over a weekend without any vote, without any public debate, and without any recourse for depositors. The legal authority is already there. The only question is when it gets used again. Now let's connect this to the current environment, because the conditions that make bail-ins not just possible but probable are converging right now. Start with commercial real estate. U.S. banks hold over $2.9 trillion in commercial real estate loans, and a significant portion of that is concentrated in regional and community banks. According to data from TREP, a commercial real estate analytics firm, office property values have declined by an average of 30% since 2022, with some markets seeing declines of 40% or more. The shift to remote and hybrid work is permanent, and office vacancy rates in major metros like San Francisco, New York, and Chicago are at or near record highs. This means that the collateral backing those loans is worth significantly less than the loan balances. When these loans mature, and over $1.5 trillion is maturing between 2026 and 2028, property owners are going to face a brutal choice. They can refinance at much higher interest rates, which makes the property cash flow negative. They can inject additional equity to bring the loan-to-value ratio down, which most don't have the capital to do. Or they can default and hand the keys back to the bank. Increasingly, default is the rational economic decision, and that means banks are going to start recognizing losses on their commercial real estate portfolios. But here's the problem. Most regional banks don't have the capital cushion to absorb those losses without dipping below regulatory minimums. The FDIC defines a well-capitalized bank as one with a Tier 1 capital ratio above 6% and a total capital ratio above 10%. But many regional banks are already operating close to those thresholds after the unrealized losses on their securities portfolios. If they start taking realized losses on commercial real estate, their capital ratios fall, they get downgraded by regulators, and they either have to raise new capital, which dilutes shareholders and signals distress, or they have to shrink their balance sheet by calling in loans and shedding assets, which creates a credit crunch. And if the stress accelerates and depositors lose confidence, you get a bank run, and the FDIC steps in with orderly liquidation authority. Now let me walk you through what that actually looks like in practice, because most people have no idea how fast this happens. Let's say a regional bank, I'll call it hypothetical regional bank, HRB, has $50 billion in assets and $40 billion in deposits. They have $8 billion in commercial real estate loans that are underwater, and they're facing $2 billion in unrealized losses on their securities portfolio. The bank is still solvent on paper because they haven't realized those losses yet, but confidence is starting to crack. Maybe there's a news article about their CRE exposure. Maybe a credit rating agency downgrades them. Maybe a competitor fails and depositors start getting nervous. Whatever the trigger, deposits start flowing out. In week 1, they lose $2 billion in deposits. No problem. They tap the Federal Reserve's discount window and borrow short-term to cover the outflows. In week 2, they lose another $3 billion. Now they're starting to burn through liquidity. They sell some of their securities portfolio to raise cash, but remember, those securities are underwater, so they realize $500 million in losses, which reduces their capital. In week 3, the outflows accelerate. They lose $5 billion in deposits. They're now in crisis mode. They go to the FDIC and say, we need emergency funding. The FDIC runs the numbers, looks at the capital ratios, looks at the loan book, and determines that the bank is insolvent or at imminent risk of insolvency. At that point, the FDIC invokes its orderly liquidation authority. On Friday afternoon, they announce that the bank is being placed into receivership. The bank closes, trading in the stock is halted. And over the weekend, the FDIC takes control. They create a bridge bank, transfer the insured deposits and the performing assets into the bridge bank, and they start the resolution process. Shareholders are wiped out, bondholders take a haircut, and uninsured depositors, anyone with more than $250,000 in that bank, get converted into equity in the bridge bank or the restructured entity. On Monday morning, the bank reopens under FDIC control. Insured depositors have full access to their funds, but uninsured depositors are now equity holders in a restructured bank, and their claim is worth whatever the FDIC determines the residual value to be after paying off the senior creditors. In many cases, that's 30 to 50 cents on the dollar. In worst-case scenarios, it's zero. This is not a hypothetical process. This is exactly what the FDIC did with Washington Mutual in 2008, which was the largest bank failure in U.S. history at the time. WAMU had $307 billion in assets and $188 billion in deposits. When it failed, the FDIC seized it, sold the assets to JP Morgan for $1.9 billion, and depositors above the insurance limit initially faced uncertainty about whether they would be made whole. Ultimately, they were protected because JP Morgan assumed all the deposits as part of the acquisition, but that was a business decision by JP Morgan, not a legal requirement. If JP Morgan had refused, those uninsured depositors would have been in the creditor pool fighting for recovery. And here's the critical point. The FDIC does not have the resources to protect all uninsured deposits in a systemic crisis. The Deposit Insurance Fund, which is the pool of money the FDIC uses to cover insured deposits, had $129 billion in it as of the end of 2025. That sounds like a lot, but U.S. banks hold over $18 trillion in total deposits, and roughly 40% of that, about $7 trillion, is uninsured. If you get a cascading series of regional bank failures where multiple institutions go down in a short period, the DF gets exhausted very quickly. At that point, the FDIC has to go to the Treasury and ask for a credit line, which means taxpayers are on the hook, or they start imposing losses on uninsured depositors through the bail-in mechanism. Given the political environment and the public's hostility toward bailouts, the path of least resistance is bail-ins. Now, let's talk about derivatives, because this is the mechanism that makes the hierarchy even more brutal for depositors. Under the Dodd-Frank Act, derivatives are given super priority status in a bank failure. This was a carve-out that the big banks lobbied for aggressively, and it means that if a bank fails, the counterparties to its derivative contracts get paid before almost anyone else. The logic, according to regulators, is that derivatives are part of the financial plumbing of the global system, and if you don't unwind them cleanly, you create systemic contagion. So they get special treatment. But here's the problem. The notional value of derivatives at U.S. banks is staggering. According to the Office of the Comptroller of the Currency, the top 5 U.S. banks hold over $170 trillion in notional derivatives exposure. Now, notional value is not the same as actual exposure. Most of these derivatives are hedged, and the net exposure is much smaller. But in a failure, those contracts have to be unwound, and the counterparties have legal priority over depositors. This means that if you have $1 million in uninsured deposits at a bank with a large derivatives book, and that bank fails, the derivatives counterparties get paid first. If there's $50 billion in derivative obligations and only $40 billion in liquid assets, those counterparties take everything, and you're left fighting over whatever scraps remain. And the courts have upheld this priority structure. In the Lehman Brothers bankruptcy, derivative counterparties were paid in full while unsecured creditors, including depositors at Lehman's UK subsidiary, lost 80 to 90% of their claims. This is the legal reality of the system we're operating in right now. Let me connect this to a broader historical pattern because what we're seeing is not new. It's a cycle that repeats whenever debt levels become unsustainable and the financial system comes under stress. The closest parallel is the savings and loan crisis of the 1980s and early 1990s. Between 1986 and 1995, over 1,000 savings and loan institutions failed in the United States. These were banks that specialized in mortgage lending, and they got destroyed when interest rates spiked in the early 1980s. They were borrowing short-term from depositors at low rates and lending long-term in mortgages at fixed rates. When the Fed raised rates to fight inflation, their funding costs exploded, but their mortgage income stayed fixed. They became insolvent. The government created the Resolution Trust Corporation to take over and liquidate the failed institutions, and the total cost to taxpayers was over $130 billion, which in today's dollars is well over $300 billion. But here's the key difference. In the S&L crisis, depositors were protected. The government ate the losses because the political consensus at the time was that protecting depositors was essential to maintaining confidence in the banking system. That consensus no longer exists. After 2008, after the massive bailouts, after the public backlash, the policy framework shifted. The new doctrine is that shareholders and creditors, including uninsured depositors, should bear the losses, not taxpayers. That's why Dodd-Frank was written the way it was. That's why bail-ins are now the default resolution method. The rules changed, and most people have no idea. Now let's talk about what you need to do, because understanding the problem is useless unless you take action. The first and most immediate step is to assess your exposure to any single institution. This is not complicated, but it requires you to actually sit down and go through every account you have. Bank accounts, brokerage accounts, cash management accounts, money market funds, certificates of deposit, add up the total at each institution. If you have more than $250,000 at any single FDIC-insured bank, you are exposed. That amount above the limit is at risk in a failure. The solution is to spread your deposits across multiple institutions so that you stay under the insurance cap at each one. Yes, this means opening additional accounts. Yes, it's more administrative work. But the alternative is taking on uncompensated risk that could cost you 50% or more of your uninsured deposits if that institution fails. And if you're running a business or you have operating capital that requires large balances, there are solutions for that too. One option is intra-fi network deposits, formerly known as CDARS and ICS. This is a service that allows you to deposit money at one bank, and they automatically spread it across a network of member banks in increments below the FDIC limit, so every dollar is fully insured. You still have a single point of contact, a single statement, but your money is distributed and protected. Another option is to use Treasury money market funds, which invest in short-term U.S. government securities. These are not FDIC insured, but they're backed by the full faith and credit of the U.S. government, which, from a credit perspective, is as safe as it gets. The key is to get your money out of uninsured deposit accounts at banks that have concentrated commercial real estate exposure or weak capital ratios. The second thing you need to do is build a position in assets that have zero counterparty risk and that exist outside the banking system. and the only assets that truly meet that definition are physical precious metals, gold, and silver. When you hold physical gold or silver, you own final settlement. There is no bank, no broker, no intermediary that can fail and take your claim with it. And historically, in every banking crisis, in every currency crisis, in every period of financial repression, gold and silver have preserved purchasing power. Right now, we are seeing record levels of central bank gold buying. In 2024, central banks added over 1,000 metric tons of gold to their reserves. And in 2025, that pace continued. The buyers are not Western central banks. They're China, Russia, India, Poland, Turkey, and the central banks of the Middle East. These institutions are moving away from dollar-denominated reserves and into gold because they see the same vulnerabilities in the system that we're discussing. They understand that the dollar-based financial architecture is over-leveraged, that real interest rates are negative or barely positive, and that the endgame is inflation and currency debasement. When central banks, which have access to the best data and the best analysis, are buying gold aggressively, that is a signal that individual investors should be paying attention to. For most people, I recommend allocating between 10 and 20% of your investable net worth into physical gold and silver. And when I say physical, I mean bars and coins that you either store yourself in a secure safe or that you hold in a fully allocated, segregated vault with a reputable custodian. The key words are fully allocated and segregated. That means the metal is in your name, it's physically separated from other clients' holdings, and you have legal title to specific bars or coins. Do not use unallocated pool accounts where you have a claim on a general pool of metal but no specific bars assigned to you, because in a systemic crisis, those claims can be frozen or subordinated. And do not rely on ETFs like GLD or SLV, because while they're convenient, you don't own the underlying metal, you own shares in a trust, and the fine print of those trusts includes clauses that allow for cash settlement instead of physical delivery under certain conditions. You want metal that you control directly. The third move you need to make is to educate yourself on the difference between liquidity and solvency, because this distinction is critical to understanding which banks are at risk. Liquidity is about short-term cash flow. A bank can be solvent, meaning its assets are worth more than its liabilities, but still fail if it doesn't have enough liquid assets to meet withdrawal demands. This is what killed Silicon Valley Bank. They were technically solvent if you valued their securities at par, but they didn't have the liquidity to meet the run, and when they tried to raise cash by selling securities, they realized losses that destroyed their capital. Solvency is about the balance sheet. If you mark all of a bank's assets to their true market value and compare that to their liabilities, is there positive equity or not? Right now, many regional banks have latent insolvency hiding in their held-to-maturity portfolios and their commercial real estate loan books. The losses are there, they just haven't been recognized yet. The banks that are most at risk are the ones that have both liquidity problems and solvency problems. High concentrations of uninsured deposits that can flee quickly, low levels of liquid high-quality assets like cash and short-term treasuries, large portfolios of underwater securities, and significant exposure to commercial real estate loans. You can identify these banks by looking at their call reports, which are public filings with the FDIC. Every quarter, banks have to disclose their assets, liabilities, capital ratios, loan concentrations, and funding sources. If you have uninsured deposits at a bank, you should be reviewing their call report every quarter. Look at their Tier 1 capital ratio. If it's below 8%, that's a yellow flag. Look at their CRE concentration. If commercial real estate loans are more than 300% of their total capital, that's another yellow flag. Look at their unrealized losses on securities. If those losses are large relative to their equity, that's a red flag. And look at their deposit composition. If more than 40% of their deposits are uninsured, that means they have a fragile funding base that can run quickly. If you see multiple red flags, move your money. Don't wait for the headline that the bank is in trouble, because by the time that headline appears, the bank run has already started and you're too late. The fourth thing you need to understand is the macro timeline, because banking crises don't happen overnight. They unfold in stages, and recognizing what stage you're in allows you to position before the majority. Stage 1 is quiet deterioration. Loan losses are building, unrealized losses are growing, but the system looks stable on the surface. The stress is hidden in the balance sheets, not visible in the headlines. We were in Stage 1 from 2022 through early 2023. Stage 2 is the trigger event. One or more institutions fail, confidence cracks, and the market starts pricing in broader risk. We saw Stage 2 in March 2023 with the failures of Silicon Valley Bank, Signature Bank, and First Republic. But those were contained through emergency interventions, the systemic risk exception, the bank term funding program, and coordinated action by regulators. Stage 3 is contagion. This is when failures start cascading, when the interventions are not enough to restore confidence, and when the fragility becomes system-wide. We are moving towards stage 3 right now, and the catalyst is likely to be the commercial real estate maturity wall that hits in full force in late 2026 and 2027. Stage 4 is the policy response. This is when central banks open the liquidity floodgates, when governments invoke emergency powers, when bail-ins are implemented, and when capital controls are put in place. Stage 4 is where the rules get rewritten in real time, and if you're not positioned before Stage 4 begins, you're going to be trapped. And Stage 5 is the reset, where the monetary system, the banking system, and the structure of finance are fundamentally restructured. We saw a version of this after the Great Depression with the creation of the FDIC and the abandonment of the gold standard. We saw it again after World War II with Bretton Woods. And we're likely to see it again in the coming years with the rollout of central bank digital currencies and a new international monetary framework. Understanding these stages allows you to see where we are in the cycle and to position accordingly. So here's the action plan. Go through your accounts today and make sure you're not over the FDIC limit at any single institution. If you are, spread your deposits or move the excess into Treasury money market funds. Second, allocate 10 to 20% of your portfolio to physical gold and silver. Not ETFs, physical metal in your control. Third, reduce your exposure to banks that have high CRE concentrations, weak capital ratios, and large unrealized losses. Fourth, understand that the next crisis will not be resolved with bailouts. It will be resolved with bail-ins, where your deposits above the insured limit can be converted into equity in a failing institution. And fifth, recognize that we are in the late stages of a credit cycle, that the commercial real estate maturity wall is unavoidable, and that the policy response will involve inflation, financial repression, and wealth transfers from creditors to debtors. The FDIC changed the rules. You are last in line. And the next wave of bank stress is not a matter of if, it's a matter of when. The only question is whether you're going to see it coming and position yourself accordingly, or whether you're going to be part of the collateral damage when the system comes under pressure. This is not about fear, this is about preparation. And preparation is what separates those who preserve wealth from those who lose it. I'll see you in the next one.